When we talk about banks getting into trouble, many people assume that insolvency and failure mean the same thing. But in reality, they are very different situations. A bank can actually become insolvent, meaning its liabilities are greater than its assets, and still continue operating without shutting down. Insolvency simply reflects financial weakness on paper, while failure is much more severe. It happens when the bank is forced to close, liquidate, or when depositors and creditors suffer real losses. Because closing a bank is messy, expensive, and can create panic in the financial system, governments usually prefer a quieter solution. Instead of letting a weak bank collapse, regulators often merge it with a healthier bank. This approach protects customers and keeps the system stable, which is why actual bank failures are far less common than people think. In fact, during normal economic times, bank failures are surprisingly rare. Historical data shows that only a tiny fraction of banks fail each year. The reason is that multiple safety nets exist to support them. Central banks step in as lenders of last resort and provide emergency liquidity when banks face short-term cash shortages. Regulators also monitor banks closely and intervene early. Large institutions, especially global ones, are often considered too important to the economy to be allowed to collapse, giving rise to the idea of too big to fail. So rather than allowing failure, authorities recapitalize, restructure, or merge these banks to avoid wider damage. However, during crisis periods like the global financial crisis, the number of failures increases because financial stress spreads quickly across the system. This brings us to the idea of systemic risk. When a large bank faces trouble, its problems don't stay contained. They can spread to other institutions, creating a domino effect across the entire financial system. To reduce this risk, regulators identify systemically important financial institutions and require them to hold extra capital buffers so they can absorb losses more easily. Still, banks remain heavily leveraged businesses, which means small losses can quickly grow into serious problems. That's why credit analysts cannot simply classify banks as either safe or failed. Instead, they must view bank risk as a spectrum. At one end are highly creditworthy banks with strong ratings and stable finances. And at the other end are distressed or defaulting banks. Most institutions lie somewhere in between,